Okay, thank you, Commissioner. My name is James Fox. I'm the Property and Casualty Director here at the department, and I'm joined also by Ned Cataldo, who is our financial analyst in the financial reg, and pretty much is along with Colin Wilkins, in charge of a lot of pretty much all of financial reg right now. Yeah, the topic today is surplus lines. I actually I've always loved surplus lines. But I also we've made quite a few slides, so we'll go to the first slide, which is the list of things we're going to talk about today. I don't really feel a need to read all those to you, so if you want to skim those, you can do that right now. What I'm going to do, I've decided, is we're going to go to the first slides, and then I'm going to talk a little bit about the admitted market and the non-admitted market. I know we have a lot of insurance people here today, so they probably don't need this, but I also want to make sure that the webinar is for the public who might not understand this stuff. So I'm going to try to make it so everybody can understand it. So we all know admitted companies, that's what, you think about that, the State Farms, the Amicas, all those companies that we all know of, and they are admitted in New Hampshire, and they are highly regulated, and they're usually highly regulated mostly in the terms of auto insurance, and fire insurance, your homeowner's insurance, for in personal lines, and then to a slightly lesser extent commercial lines too, the admitted companies. And then we have the non-admitted companies, which you've already mentioned, and usually non-admitted we also call those surplus lines companies, and they are, as the commissioner said, I always think things are too risky. Things are unusual. People don't have enough experience. People are new to something, so they will not be something won't be sold to them in the admitted market. So what we have is the non-admitted surplus lines market, which is not as highly regulated as the admitted market. So I thought the first thing, well, I will read. So the first slide says non-admitted specialized insurance covering unique, high risk or high capacity exposures that admitted carriers won't insure. So that is a good encapsulation of what it is. Now we look at it from regulators, so I think that's probably why some people have tuned in. And there's really two pieces. I always think of that with that. There's 40524, which is foreign insurance companies and their agents, and then 40524 specifically addresses surplus lines companies. So if you want to look at the statute, that's the site. You'd go there. We're going to talk about it now. And then another case, which is very important, that is related to 40524 and was focused on 40524 is Grand China. And if you work here at the department, Grand China was when it came out in 2007 a big case, and it still remains a big case. I talk about it quite a bit in P&C. And so Grand China. So I'm going to explain Grand China to you, and that's going to say what the world was before Grand China in surplus lines and what the world was after Grand China in surplus lines, because things became different. So Grand China was about a Chinese restaurant called Grand China, and a patron went to Grand China and had a few drinks and got into an accident after, maybe more than a few drinks, and then he ended up killing someone. So then there was a lawsuit that was brought against Grand China, and Grand China had a surplus lines policy that was issued by United National Insurance Company. And they had, unfortunately, they had received a cancellation notice. And so as far as the insurance company was concerned, at the time of the accident, there was no insurance because it had been canceled. And then that was the issue that was primarily litigated at the Superior Court level, and the Superior Court judge found that no, the policy had not been canceled because it wasn't in compliance with 417C, which is our cancellation statute. And then the department and most of the insurance people were surprised because at that point in time, much like now, we had what we call regulation light as to surplus lines companies, just like also as to reinsurance, which you don't do at all, and also as to large commercial policyholders. So 417C didn't apply, and we had for our representation, we had Kelly Ayotte, who's now governor, who was AG, and Glenn Perlow, who used to be the banking commissioner. But this was kind of a who's who. On the Supreme Court, it was Judge Broderick, who was a Divine Millimet person. There was Judge Galway, who was formerly a Divine Millimet person, both insurance people, and Gary Hicks, who's a really nice person and also was a Wigan and Norrie person. So it was a ton of insurance experience. And then the actual attorneys that represented all the parties, because this became a big deal, was we had Margaret Nelson at Soloway and Hollis, who was representing the surplus lines company. We had Russ Hilliard, who was a luminary in the insurance world, representing the intervener, who was the actual agency. And then we had our last, we also had Paula Rogers, who was a former commissioner at Divine Millimet at that point, who was representing the Property Casualty Insurance Association, which is, I'm not sure if Allison Cooper's out there. So we had everybody in play here. And what the issue was is that we had actually, back then what we had was we had a warning. And the warning, and I'm going to read it, just said, so 40524, which is surplus line statute right now, back then what it said was the company issuing this policy has not been licensed by the state of New Hampshire. And so as a department, like, we don't license them, so we're not regulating them in our head. And the rates charged have not been approved by the Commissioner of Insurance. The company issuing this policy becomes, if this company becomes insolvent, it is not, the guarantee fund does not apply. So, and the department position back then, which I understand, was like, well, we don't license them, so they're not one of our licensees, so we don't regulate them. We give out a warning, just like we give to large commercial policyholders, and then we move forward. The Supreme Court said that's not what this said. All this says is that they're not going to get in the guarantee fund and you don't do rates. It does not say you don't regulate them. So ultimately what the Supreme Court says, we see nothing in your statutory scheme as a department, Title 37, that says you don't regulate them. Therefore, you do regulate them. And therefore, the cancellation non-renewal statute does apply. So now this became a huge issue for us, since we actually weren't regulating them, and we had understandably weren't, based on just how we understood how the law worked. So this was a huge change, probably the biggest change in probably regulatory world ever in New Hampshire. We've had some cases about the fire policy, but this was like the biggest one. That's why I find it very exciting. So then it became, well, what do we do? So obviously the answer would be, and I'm sure the commissioner would know because he was a former legislator, we went to the legislature and we flipped the Grand China decision. So what we did was we specifically put in 40524 that it does apply to what we say it applies to, that it does apply to, and if we don't say it applies, then it doesn't apply. So the Supreme Court says you didn't say anything, so we're going to apply it to everything. So we said it only applies to what we say it applies to. So surplus lines at this point applies to unfair insurance trade practice, and that's really the biggest thing that we do here for surplus lines when it comes in. A lot of times it's part of the unfair insurance trade practice, insurance claims practice, so that's what we work through. Was the settlement equitable and all of those things? We have those cases and we work on those. And then over time we have added things, and most recently the law for many, many years did not say our investigation statute applied, so we didn't we couldn't really use it. So we added, I think 2 years ago, we added that 400A16 applies. That's our investigation statute. And then most recently it came up that the adjuster statute, did the adjuster statute apply? Because we regulate adjusters, so we regulate adjusters as professionals, but then the question becomes, well, in surplus lines, do you regulate them there? Because you wrote that only the laws that we say apply. But then we were like, so we got a little unsure, so what we did is most recently, Commissioner Betancourt changed it to say we also, the adjusters that are adjusting for the surplus lines companies must be licensed in New Hampshire, because that is so important for making sure the claims are processed correctly. So that is kind of like just on a big picture, how the world used to be and how the world currently is. So moving on, the next thing down, no, don't believe me right here. So the next thing down is they're sold through, we say brokers, so they're sold through producers. Unlike a lot of other areas of the law, the surplus line world is producer driven in my mind. That it goes through producers. My understanding is producers pay the premium tax, so it's really all focused on the producers. And then we have the still regulation light that we deal with. And then I know a lot of people, the most questions I get about this is, when do you get to go to surplus lines? And so that has always been a question. I used to have, there was a woman here, Deb O'Loughlin, who gave me like 3 typed up things to keep and never lose. And I, of course, then did lose them. But one of them was a very old typewritten letter that said, how you get to surplus lines in New Hampshire is that you must get 3 declinations from admitted carriers. And the reason that says that is if you look back at 40524, because that's what we're working out of, Section 3, it says that as to surplus lines, as such insurance or suretyship placed with an unadmitted surplus lines company shall be for such amount as the producer, now that's probably the producer at issue, not any producer, but that producer cannot place with an admitted company. So obviously we have producers with appointments, so we don't say they have to go to every insurance company in the state and see if they can get it. They must set, so, and how do we determine whether they can or can't? And shall not be placed until the producer has first satisfied the insurance commissioner, in this case Commissioner Betancourt, that the producer cannot procure such insurance in the admitted market. So we have to have a standard. Obviously the commissioner can't sit there and every time somebody's going to go to surplus lines, like, okay it. So we put in place a rule that basically was on the typewritten letter that I lost, which said 3 strikes. So you got to go, if 3 times you get declined, you can then go to surplus lines. And this is very similar to the residual market in commercial auto. It's 3 declinations and you can go to the residual market in commercial auto. So it's a very similar process. So the process does work. And then we have also said that if it's obvious that it wouldn't be, or an admitted carrier would not write it, then you don't even need to do the 3 strikes. If it's clear on its face, and I always use like the sports thing, like in college football, when a person back in the old days, they get paid now. Before they got paid, if the person was going to stay in college for their senior year and they were worried about getting hurt, they would take out like $1 million insurance policy. That is obviously not going to be written by State Farm. So that would be something that would be okay to go to surplus lines. So I always think you can go to surplus lines if you get the 3 declinations, or you can go to surplus lines if it's obvious that it's not going to be written in the admitted market. Again, the carriers we know. Okay, let's go to the next one. And so what happens in terms of what don't you get? Why is this a different world? So the reason it's a different world is a regulatory from our perspective, and that we are a little cautious about sending people there, are really 3 that were subject. What don't you get? They are not subject to state regulations for rates and forms, ensuring fairness and transparency. So in the admitted market, all the forms come in and we look at them up front. And then the rates come in and we have actuaries that look at them to make sure everything is actually sound and everything of the forms are all consistent with their statutes, which a lot of statutes don't apply. So we don't do any of that. And that's also in reinsurance, a lot of other areas, but we don't do that. And then the guarantee fund is always a huge one. If you have a policy with an admitted carrier and that admitted carrier becomes insolvent, then what it does is that you're not all of a sudden out of luck. You then go to the guarantee fund. The guarantee fund then administers your claim, and then you're going to be okay, even though the company's going down. So that's a huge thing, because we don't want people to buy policy. We don't really, unless necessary, it's like a last resort. We don't really want to have people buying policies that don't have the guarantee fund behind them. And then the other thing, which is squarely in Ned's world, is the strict financial solvency standards, ongoing regulatory oversight. So, and I won't speak for Ned, but Ned's one commissioner, Roger Savini, used to always say, which I always felt bad about because I hear him say it all the time, is that the most important thing we have here is the financial regulation division, because if the financial regulation division doesn't work right, claims don't get paid. So Ned's here to make sure that he analyzes the companies along with Cole & Wilkins, that they claims will get paid. So, but that in terms of what we do for financial regulation and the difference between the admitted companies, which is a lot, they get a lot of oversight, versus the non-admitted is much less. So with that's kind of my more lawyer knowledge of surplus lines. If anybody heard anything and they don't want to ask a quick question, I always say people can call me. It's 271-2502, and I'm happy to talk about surplus lines all day with you if you want, because I love surplus lines. And now I will throw it over to Ned.
It's not too tough an act to follow. Thanks, James.
Yep.
I'm going to now cover, as Commissioner Betancourt indicated, some of the reasons in areas why surplus lines are important. Surplus lines, again, fill gaps where admitted insurers won't cover unique high-risk exposures. They're critical for particular specialized industries: medical malpractice, construction professional liability, such as engineers, architects, cyber risk security, and other emerging risks. That'll be a common thing, emerging risks. Nationwide surplus lines have grown nearly $130 billion in premium in 24, a 12% increase over 23. I just looked at some statistics for 25, and it looks like the growth did slow, but still close to 10% through the third quarter. Liability and property dominate. That's we commonly think of it as a P&C product and regime. 70% of the surplus lines are increasingly relying on these markets for these complex businesses. And it has even bled into the homeowner space for more difficult to cover areas. Just delving a little bit deeper, the industry's most impacted, cyber and emerging technology. Surplus lines now write more than 60% of the U.S. cyber premium market, which is a growing and important market. Breaches are constant and ever never-ending challenge for companies, and that's generally insured and then reinsured through the surplus lines markets. Construction and high-value projects that are difficult or at odd stages, etc. Those are often have highly tailored coverage that doesn't fit neatly into the admitted market. Increasingly, healthcare, professional liability, specialized malpractice, etc. D&O coverages. These are things that you'll see predominantly going into the surplus lines arenas. And then lastly, you're seeing this more and more emerge, less in New Hampshire, but more in some of the hurricane-prone states and other cat-prone states. You're seeing catastrophic risk actually bleeding into these markets as well, on terms and coverages that admitted carriers can't or won't provide. They're here to stay. Surplus lines are here to stay. The share is growing and will continue to grow. Many of the risks in recent years are stickier. The markets have grown comfortable in seeking those coverages through these regimes, and they likely won't return to the admitted market. You will, from time to time, see emerging business lines begin in the surplus lines market, and then eventually make their way over to the admitted market as actual standards are defined and risks are learned and etc. But many of these risks will likely stay in surplus lines for the foreseeable future. Growth is very much driven by MGAs. We're seeing this with a lot of our surplus insurers. They have strategies that are intertwining themselves with the MGA market, specializing in unique niche areas. And generally, they're high margin businesses for them. So these are growth opportunities for some of the bigger insurers as well. Insurers are increasingly delegating the underwriting authority through these regimes and working, again with these smaller players are becoming very good at writing these risks very efficiently. And then lastly, this is helping to drive premium growth, and it's a self-feeding system where the big insurers are relying on more and more on these specialty players to help provide provide profitability at the margins through programs like this. So how do we evaluate the solvency of these entities? We do follow the NAIC standards and the NRRA framework. I'll come to the NRRA framework a little bit later, but that's the federal regulations that essentially helped crystallize and produce some rules around these markets. Insurers must be authorized in their home state of jurisdiction. So if they're not New Hampshire domiciled, let's say they're Massachusetts domiciled, they must be authorized in their home jurisdiction to write that line of business. They have to have at least $15 million of surplus. And they have to submit annual financial statements and compliance certificates from their stated domicile to the department. Alien insurers, which for our purposes means non-U.S. Domiciled entities, they must appear on the NAIC's quarterly alien listing. The NAIC puts them through several filters to make sure that they're appropriate participants in these spaces. How does the licensing and oversight work? Well, we maintain an eligible surplus lines list. You can find it on our website. There's about 240 companies. We update that on an annual basis. Foreign and alien surplus line insurers are not licensed, as James said earlier, in New Hampshire, but are eligible based on the solvency and compliance matters we spoke about previously. What's unique about New Hampshire is that it's one of the few states that actually has allows for domestic surplus lines companies. What that means is that domestic surplus lines companies are domiciled New Hampshire companies that write traditional lines of business, but they've been approved by the commissioner to also write surplus lines within the state of New Hampshire. We're one of only a handful of states that allow that today. We currently have 7 domestic surplus lines companies. Brokers must hold P&C license with surplus line authority. As James alluded to, they work with our premium tax group to provide premium tax reports and opt-ins, etc. every surplus lines policy must be placed by a broker who's properly licensed and eligible. And policies must disclose, as James said earlier, that it's not New Hampshire license and it's not covered by the guarantee fund. I'll go quickly through this, but this is the NRRA is the federal framework that allowed portability here. This market did exist prior to this, but the Non-Admitted and Reinsurance Reform Act was under Dodd-Frank. It created universal standards to make this a little bit more streamlined across states. It established the home state as sole jurisdiction, etc. It just made it easier for these, both this and the reinsurance market, which is another critical non-traditional market that is critical for providing both expanded coverage and unique coverages. So this brings us towards the closing of this. I promise there's a bit more here, but again, the surplus lines market is critical for covering risks that the admitted market can't or won't touch. With $130 billion in premium nationwide, it's big, specialized, and not going anywhere. New Hampshire ensures that to the best of our ability, that these insurers are financially strong and compliant, while the NRA provides a consistent national framework. Together, these measures do provide consumers with some protections, although not as much as the admitted market, and keep the market flexible and competitive. And final slide, I'll turn over to James, but it's really just to really wrap up and remind everyone of some of the key differences between the admitted and surplus lines market.
Okay. Yeah. Yeah. So obviously, the biggest thing about the admitted market is that we look at the rates and forms, and I guess I didn't say this, but in the forms world, the forms in the admitted market are pretty consistent and they have to be structured like the Grand China case. And they can, if you're going to have a cancellation, this is how it has to happen. Everything kind of has set up. This is the way it must work. In the surplus lines, it's not like that. The forms don't have to be written a certain way. That they're much more like, in my mind, a little like one-offs. And then the guarantee fund is obviously something that you're not going to get if you're in the surplus lines. And the strict solvency requirements that are in the admitted market are not going to be as strict, although we do have solvency issues as it is in the. So it's not going to be as strict in the non-admitted, which is like surplus lines, as it is in admitted. And then all this kind of comes together that it's the consumer protection in the admitted market, which is usually actual like individuals and homes and that kind of stuff, and in cars that like you could never go to surplus lines and auto. That's a way to put it. That so because we have a take all comers, you'll always be in. You will never have a surplus lines auto other than Uber has one because they're a national. They're a little bit different. They have their own statute. And homeowners, you'd be in surplus lines. A good example is if somebody bought a home at auction as is, and it's obviously it's in really bad shape, then that their option probably is they're gonna have to go to surplus lines. But surplus lines again, I don't want to. I think maybe that's not a little too negative. Surplus lines has its place. It's necessary for these unique risks and high risks, and to get things kind of going. In the insurance world, we want to have insurance, and it is much more flexible than the rigid nature of the admitted market. I think it's a credit to the producers how the producers operate in this market. It is really fantastic how complicated it is for them in my mind. And then the whole obviously that we're going to end with. You must get 3 declinations or be able to really say with a straight face that there's no way that this would be sold in the admitted market, and then that's how you jump into the producers can jump into the surplus lines market. There has traditionally been a feeling that surplus lines is more expensive and it isn't as highly regulated, so it's maybe not as safe. But it does play an important role, and I think we've struck the right balance about when people can go to surplus lines versus staying in the admitted market. But obviously things change over time, and we try to be, also the department tries to be flexible and innovative, so we'll see how things develop in the future. Thank you for tuning in. I think we usually throw back to the commissioner at this point. Oh, maybe questions first.
Yeah, let's do questions first. So Andrew, do you want to work through the questions? Yes, let's see here. We have a couple of them. The first is the three strikes rule. If an admitted carrier offers renewal terms and the E&S company offers a lower price, how does this meet the three strikes? The person asks, we compete against E&S companies in this way regularly.
Well, the three strikes is three declinations, so you didn't receive a declination in the admitted market, so it's available in the admitted market. So at this point in time, I'd say you need to remain in the admitted market under the current standards. But if they're, as I said, if in any topic we discuss, if um, industry or consumers think it's not operating correctly, they should contact us, and that's why I gave my phone number out to a certain extent, and then we will consider any potential changes that might be appropriate, but that ultimately would be, I'm looking at the commissioner's little box, the commissioner's box, his decision. But we obviously would feel any tweaks or changes that might be appropriate in any area of the law. So if someone feels like the current standard isn't appropriate, they should either contact maybe me or Ned, and then we would take a look at it and get back to you.
And Dave, I would just add that, sorry, James, didn't mean to step on you there. Dave, I would just add that this has been a topic of conversation between myself and Joan Peugeot over at the Big I for a couple of years now. We have started some internal conversations around whether or not the three strikes rule as it is currently designed makes sense. And those conversations are substantive and serious within the department. What I'm always on guard to protect against are absurd results. And obviously, as long as the consumer understands what the pros and cons of being in the admitted market versus the non-admitted market are, beyond just in the example that you cited here, that the E&S company is offering a lower price. So as long, the lower price is obviously very attractive, I'm sure, to the client that you're working with, so long as they understand that they're not getting some of the added consumer protections that come with a product that's in the admitted market. So how you make those disclaimers clear, how that information is presented to the consumer is all going to be important. It's all part of the discussion that we're having. But I appreciate you raising the topic. I suspected that it would come up this morning. We are working on that and will continue to do so.
The only other question that we have is from Julie, and yes, we will be offering slides as a PDF along with a link to the video on our YouTube so that you can rewatch the presentation at your convenience. I guess we do have another question here. It says, with the proliferation of E&S, do you see New Hampshire or other state regulators increasing regulatory oversight of SL carriers? By way of example, the NH regulation granting investigation authority over SL carriers. Are there any similar regulations on the horizon?
Well, I don't think at this point there's anything on the horizon. I mean, I think we look at things as they come up, and then, like we just at least clarified, the fact that we are going to require, we are going to have oversight over the adjusters who are adjusting surplus lines carriers. So it's kind of as things come up, and maybe the discussions we're having about when you get to the surplus lines market might impact, well, how much regulation we're going to have over the surplus lines market. So, maybe so, but it's kind of like as things happen, we try to be nimble and flexible, and then we change things as we go after having rounds of discussions within the department. Ultimately, the commissioner makes those calls.
The other thing I would add, if I could, is, we talk about the idea that there's lighter regulation on the financial reg side, for example. All these companies have to be domiciled in a domestic state that is part of the accreditation, the NAIC accreditation program. So what that means, and I don't want to open a Pandora's box here, is that each state has to live to a certain standard of financial analysis, financial examination, licensing, etc. So all these companies do go through those rigors we rely on on the other 50 states that when those entities are not domiciled in New Hampshire. So there's a lot of rigor that goes into that analysis. And we are peer reviewed by our other states as part of the NAIC accreditation standards, etc. So there's a number of protections already implicitly built in from the financial solvency end. I don't want to have that come off as though that there's no protections here. It's just it is a different standard in terms of our ability to deny. DJ, I don't know if you have anything to add to that.
No, Ned, I think you very well put it. You led me into the point that I was going to make, which is, as James mentioned, we're constantly seeing if there are opportunities for us to tweak or to enhance some of the consumer protections that we have in place at present, where we do have jurisdiction, where we have the legislature has granted us the authority to be able to do some things to enhance what we currently have. But for us to consider or to move forward with something dramatically different by way of trying to increase regulatory oversight of surplus lines, as Ned pointed out, it would have to be within the context of a larger conversation amongst our colleagues at the National Association of Insurance Commissioners level, for the reasons that he mentioned, plus a number of others, which is how would all of this work if there was one state that was a vast outlier in how it approached surplus lines versus the rest of the country. There'd be a lot of follow-on ripple effects to that, separate and aside from the very important points that Ned just raised. So that's kind of the current play of things. And James, I don't know if you're aware. I know that Christian kind of keeps an eye on some of this stuff. Have there been any discussions at the NAIC level? There is a surplus lines working group that I know does a lot of work in this space. I don't know if they're considering anything of substance in terms of additional oversight that they'd like states to consider.
I'm not aware of that. I do know that, whenever we go to NAIC, the law firm Locke Lord's there. And Locke Lord does a state-by-state analysis of surplus lines. So, before we met today, I kind of went through their state-by-state. So, there are opportunities to some states have a lot of statutes on it, and some are more like New Hampshire's a one page on the Locke Lord, and I think that is kind of consistent with kind of the New Hampshire way. But obviously, if there's if there's some tweaks that seem like they're a good idea, I think we can handle that in terms of like what I do, which is non-financial stuff. So when Ned makes a change, that has a lot of implications, and it has to be consistent with NAIC rules. Otherwise, we have accreditation problems. But in what we do more in the P&C part, the substantive piece, that's more. I'm more flexible than Ned can be. So yeah, if there's a good idea, absolutely. I don't want to be forever. This is the way it is. It can never change. But it's kind of a case by case analysis.
I'm not seeing any other questions, but I have put some information in the chat window for our viewers. We have all of our monthly webinars on our YouTube page. We've put a link to there and invite you to browse our channel to see if there's something of interest for you. I have put our consumer services information there. If you have a question about coverage or a claim or anything else, please reach out to our consumer services unit. And I've put the email address for our communications unit. If you have a question that we didn't cover today, we're happy to forward that to our subject matter experts. Please email me and my colleague AJ at the communications unit, and we will forward that along. Commissioner, any closing remarks before we end the presentation?
I think we've said it all. I'll just reiterate how much I appreciate everybody's interest in engagement, and frankly, what is one of the most important but least understood corners of insurance. And we look forward to seeing you all next month at our next webinar.